INDAS 33. Earnings per share. Earnings per share. Any doubt? Okay. Two things. There are two types of EPS. One is basic. Other one is, what is the formula of basics? Net profit or loss attributable to equity shareholders divided by weighted average outstanding number of equity. Done? All right. So how we calculate this net profit? This numerator. We'll not talk about diluted right now. After that, after discussion of so many things of basics. Okay, how to calculate the numerator? It's EBIT minus interest. Now, wait. When you talk about interest, guys, sometimes it could be as per effective rate of interest, because we follow INDAS and we follow financial instrument chapter also. So if we follow financial instrument chapter also, we have a financial liability, and we could have recognized the financial liability based on effective rate of interest, AMC category. So now the interest would be deducted as per the AMC category only and as per the effective rate of interest. Guys, understood? Now then we got EBT. Then tell me. Tax. Now once again, as far as tax is concerned, we do tax expense, and we know tax expense means current tax plus minus deferred tax. Now the deferred tax concept will be also be there. It is to be reduced. Guys, understood or not? Next. In short, do not think from CA inter point of view. Think from CA final INDAS point of view. So many additions are there, like effective rate of interest, like DT and all. So please think properly, okay? Now, effective EAT, earnings after tax. Now what you will do? Minus preference dividend. Preference dividend. For preference dividend, there are two things. Is it a cumulative preference share or non-cumulative? If it is cumulative, deduct always. If it is non-cumulative, deduct only if it is declared. Okay? Then minus any premium paid on early repayment of preference shares. We redeemed the preference shares and we paid the premium to be deducted. Understood or not? Tell me, guys, understood? Then you will get net profit or loss attributable or available for equity shareholders. Guys, understood or not? Done? Okay. All right. Come to this question number 301. Question number 301. Yes. Okay. Calculate the following information for the purpose of calculation of basic EPS for the year ended 31st March 19. Earning before interest and tax 35 lakhs. Outstanding debentures as on 1/4/18 1 crore 20 lakhs. 8% interest. Outstanding cumulative 9% preference shares 8 lakhs. Dividend not declared. 10% non-cumulative preference shares issued on 1 June. It's 10 lakhs. It's 10 lakhs. Dividend is declared. Out of about 9% cumulative preference shares, 25% redeemed in the beginning of the year. Redeemed in the beginning of the year. 3 lakh. Extra paid is premium on the redemption write-off from the security premium account. Issued 9% debenture with the redemption right at a premium of 10% after 5 years, 750. Then preliminary expenses written off 1 lakh. Outstanding equity shares during the year 1 lakh numbers. Tax expense 150. So many equities, so many securities. What is the question number? 30. Let's talk about the debentures overall. What are the debentures you have? So many categories of debentures you have. Let's talk about the debentures. Let's tell me. The first one you have outstanding debenture is on 1/4/18. Tell na beta. So one is your 8% debenture outstanding from 1/4/18. How much it is? So calculate the interest. 9 lakh. Very good. Any second debenture? Yes, yes, yes. Any second debenture? Yes. Issued 9% debentures with a redemption right at a premium of 10% after 5 years. How much? At which rate? Which amount you have issued? 750. And what is the rate? What is the interest? No. No. Do the effective rate of interest accounting, AMC. Why? Because you are issuing 9% debentures. When you are issuing? No date is given. Okay, issuing 9% debentures in beginning. What is the proceeds? Proceeds 7. What is the CCF? Contractual cash flow 1, 2, 3, 4, 5. What is contractual cash flow? Every year. 67,500 every year. Then redemption. Because it is going to be redeemed in the 10 at the 10% premium, na? 750 into 10%, 75 plus 20, 750, that is 820. What should be the present value at which rate so that it should equal to 750? Array, we need to calculate IRR. Huh? Can you please calculate? Okay, assume 10%. Immediately, assume 10%. Please do it. Assume 10 and then 11. Both rates. It's 768, 138. It's 739, 070. You must know the calculator tricks now. 739,070. No? Is it wrong? Wrong. It's right. Hmm? No? What happened? Yes, it is 768 only. So take this as a base. It's 10% plus increase in percentage by 1, 10 to 11. Decrease the amount. How much decrease the amount? 29068. I want to decrease the amount from 768 to 750. That is 6. 18138. So what is the x? So 10.624. This is the effective rate. Done? So tell me the interest based on effective rate. Interest for the first year. Tell me based on effective rate. It should be 750 multiplied by 10.624. 79,680. Tell me which one is the preference share? Okay, cumulative 9%. 9% cumulative. Dividend is declared or not? Not declared, but it is cumulative. Cumulative 9% preference. So please tell me the dividend. Okay, any other preference? Once more. Acha, one more thing. Out of about 9% cumulative preferential, 25%, 25% redeemed in the beginning of the year. Wait. Dividend will be changed. 25% redeemed. 75% is still outstanding. Do the working. What's the total value? It's 8 lakh. It's 6 lakhs. It's 2 lakhs. Calculate the dividend on this part only. 50. This is redeemed now. The other part is redeemed now. At what value it is redeemed? Redeemed at? Redeemed at 3 lakh. Redeemed at 3 lakh. So what is the Premium on redemption? One lakh. You remember? In this formula, any premium on redemption is coming? Screen. Okay. Even though it is written off from security premium, for calculation of EPS, you have to minus it. Okay. What about the fourth one? Fourth preference share. Tell me. I think 10%. Guys, I need to solve kya? Huh? Tell me now. What is the last one? Any other dividend? Any other preference share? Preference share cumulative 10%. Non-cumulative. How much? How much? Amount. Issued on 1st June. Dividend declared? Huh? Calculate. 10% into 10 by 12. Why 10 by 12? It is issued on 1st June. So calculate the dividend. Done? Any other thing is outstanding? Preliminary expense, okay, 1 lakh. We'll do it separately. Tax expense, okay, 150. Now, let's calculate basic EPS. Tell me, what is EBIT? What is EBIT? 35 lakhs? Minus interest. Do it. You have workings, every working you have. Tell me now. Even you should also tell me the figures, no? What's the interest value? One is 960. The other one is 79.6. What's 54? It is dividend, na? Okay, fine. And other than that, is there any preliminary expenses written off? Any preliminary expense written off? How much? Now please tell me EBT. EBT. 23? 3? Okay, what is tax expense? 1,50,000. What is EAT? 320 minus preference dividend. Yes, tell me. 54, 83,333. Any other thing? Premium paid. Wait a minute. Premium paid on repayment 1 lakh. Yes. Yes, India says from wherever you have written off for calculating EPS, you have to include in this earning. You are writing off anything from security premium and all, but for calculating EPS, you have to consider it. Consider it. Tell me. 9. 987. Divide by number of shares. $19.73. Done? Make a correction. It's not bad. 19.73. Okay, done? You asked me one doubt now. Security premium. See, it is written in the concept book. This one. Even this one. These two are the concepts. If you can read, you'll find. Yes, we have discussed the basic equity, basic earning per share portion, bit of the basic earning per share portion. Now I am resuming with the same. The question we did for the numerator. Now let's talk about the denominator. Let's talk about the denominator portion. Okay, if I would give you one situation. If I would give you one situation. 1st April opening, outstanding 120 number of shares. 1st July public issue 75 number of shares. 1st September buyback of 28,000 numbers. 1st 11 the bonus issue of 30,000 numbers. 1st January 60,000 debentures converted into equity in 2:1. How can you calculate the weighted average outstanding number? Can you please calculate it? Yes. All right. So, how we do that? Basically, 120 are the opening, multiply by 12 by 12. Public issue 75,000, multiply by 9 by 12. Why 9? See, I am assuming financial year ending on 31st March, and from July to March it's a 9-month. Buyback is 28,000. So 28,000 from September, October, November, December, January, February, March, 7 months. But we need to negative, we need to minus it because it's a buyback. So bonus issue 30,000. As far as bonus is concerned, we always do 12 by 12. Bonus has all bonus. You always give the time weight from the beginning of the previous year. Beginning of the previous year instead. So as far as current year also, we need to do 12 by 12, beginning of the year. Okay, bonus. Because bonus is issued other than money, other than cash. So basically it is issued out of the reserve and surplus. So we have the reserve and surplus from the beginning of the year only. Okay, then 60,000 debentures converted into 2:1. For 1 every 2. So 120. So 120 into 3 by 12. So do it. 120. Tell me. Is it 56250 kya? Next one. 16,333 negative. Okay, next. Okay, fine. 30,000. So what is the weighted average number? Two lakh 917. This is the weighted average outstanding. So guys, there is another way. Guys, please don't talk. Another way. There is another way to calculate. Please continue. There is another way to calculate cumulatively. So the first figure was 120, but the bonus also to be done from the beginning only now. So it's 120 and 30, it's 150. So what you need to do is 150 multiply by, now see, April, May, June, matlab till the next date I will take 3 months. Till the next date I will take 3 months. Do it. 37. Now 150 public issue added plus add, it's 225. Now from 1st July I will go to the next date. July, August, only 2 months. Only 2 months into 2 by 12. It's again 37,500. Okay, next from 225 to now buyback of 28. Let's deduct 225 minus 28. It's 197. And the date is from 1st 9 to 1st November. Again 2 months. Okay, do it. 32,833. From 197 to bonus is already done. Bonus already done. From 192 to it's 120. Debenture 120 on 1st January. So 197 plus 120, it becomes 317. 370 multiply by, the last date was September. From September you will take to, guys tell na. Huh? Sorry. Wait a minute. We did buyback now. Wait. Tell me, what about the buybacks? Wait. Once again. What about the buyback? Buyback working? It's 197 na? Till January we need to take because bonus we already took na? So September, October, November, December. Yes, 4 months. 197 into 4 divided by 12. 65, 667. And from 197 to 120 again, then 3117, it's 3 months. 3, 2, 4, 3. Tell me. 317 into 3 by 12. It's 79,250. How much? It's 219,917. Same. It's 219,917. Same. Which method do you prefer? Huh? First one? Everyone, please tell me. First one, if you prefer na, it's fine. But you have to prepare second one for the right issue. For the right issue working. We'll discuss about the right issue. In the right issue, you have to prefer the second one only. So I told you both the methods, not an issue. But okay, it's fine. Prepare the first one only. Not an issue. But in the right issue EPS working, you have to prepare the second one only. Okay. Next one. Next one more example. 1/4 outstanding 90,000 equity. Outstanding 90,000 equity of 10 each. 7 paid up. 1717 issued 50,000 equity of 10 each. Issued 50,000 equity shares of 10 each 6 paid up, 1/8 call rupees 3 on opening. Call of rupees 3 on opening. Call of rupees 3 on opening. On 1st December. Call of rupees 4 on issue. Assume partly paid shares are eligible for dividend. Sometimes partly paid shares are not eligible for dividend. Then you take them in the DEPS working basically. But here I am saying assume that they are eligible. Then you will definitely take them in the EPS working only. Now you have to check in the question every time whether they are partly paid. Yes. Whether should I continue? Whether should I consider them in the DEPS or EPS? So if the question clearly says that they are eligible for the dividend even though they are partly paid, then consider them in the basic EPS only. But suppose the question says that they are not eligible for the dividend till the time they become fully paid. So you won't consider them in the basic EPS working. You will consider them. You will treat them as a potential equity shares. Understood or not? For the diluted earning per share working. So please calculate the weighted average. Can you please calculate the weighted average? Please calculate the weighted average, guys. How to solve? How to solve? Convert partly paid to fully paid. So there are two different partly paids. One is 7 rupee, one is 6 rupee. See, there is one alternate what you are saying. Convert partly paid into fully paid. There is one another choice. That is comparatively bit easy as per my view. So what I am doing, I am discussing my opinion first. How you can calculate. Calculation of weighted average outstanding equity capital. Equity capital. Like not in numbers. I am calculating in rupees. Basically, I am not calculating in numbers. So please tell me for the first date. It's 1st April. How much shares are there? 90,000. And the paid part is 7. Multiply by 7. It becomes your share capital. Understood or not? Now the share capital, this share capital was outstanding for the whole of the year. For whole of the year. Okay. Tell me the answer, please. 630. So 630 becomes your weighted average equity capital in rupee. Now what is the next date? 17. How much shares are issued? 50,000. What is the paid part? 6. Multiply by 9 by 12. So do it. 2,25,000. Next date is August. On 90,000 you called the money. How much money you called? 3 rupees. Multiply by from 1st August. You do it 8 months. 90 into 3 into 8 by 12. It's 180. Understood, guys? Then it's 180. Huh? Yeah. December, na? How much? 50,000 into 4 by 12. It's 66667. Do it. One 1667. It's weighted average outstanding share capital. It's weighted average outstanding share capital. Now divided by 10 rupees. Divided by 10 rupees. You will get the numbers. 110,167. Simple. Tell me. Understood or not? So this is to be done as far as the paid up portion is there. Partly paid up portion is there. Once you calculate the share capital, divide by 10, it's weighted average number of shares. Fine with this working? You have second option that they convert every time convert into equal numbers or the equivalent numbers. That is the second option you have. Okay, now there are some important things I want to discuss. Partly shares I discussed with you. Partly shares I discussed with you. See what is written. Partly paid shares are treated as fraction of equity shares to the extent they are entitled to participate in dividend. So if they are participating in dividend, we will take them in the EPS working, basic EPS working. I discussed one question. This is the one another example you can do at your in your home. Bonus issue, split, share consolidation. We always take 12 by 12. We always take 12 by 12. Now this is interesting. This is interesting. Please read the heading. Compulsory convertible debenture or preferential. From very first day, I issued, on the first day, I issued the compulsory convertible debenture. Debenture, they are going to be compulsory convertible after 2 years. But from today onwards, I will consider them as shares, equity shares. What I said, see, today I have outstanding equity shares of 1 lakh. Today I issued 50,000 debentures. But these debentures are compulsory convertible after 2 years. And the conversion ratio is 1:1. Tell me, should I take these debenture from after 2 years or from today only? The debenture would be converted, na? The debenture would be converted into equity, na? These are compulsory converted. That means you remember in financial instrument fixed to fixed conversion, equity. You remember equity, if the debenture is already fixed to be converted into a fixed number of equity, it is equity only. So it is an equity instrument. It is not the liability technically. So from today onwards, you take 50,000 also as an equity share. From today also you take 50,000 as an equity share in the basic earning per share. You don't treat them as a potential equity. You don't treat them under diluted only. You treat them under basic only. If that is compulsory convertible into fixed number. Guys, are you understanding or not? So let's do one question. Example 8. Please do it right now. Do it. Example 8. Outstanding equity shares 1st April 18, 1 lakh numbers of 10. Issued 9% convertible, compulsory convertible debenture on 1/7. That is 10,000 numbers, but the conversion will be done after 3 years in the ratio 3:1. 3:1 means for every one debenture, I will give you 3 shares after 3 years. But since it is a compulsory, so you take it right now only. You consider them as equity share right now only. Please tell me how many shares are there. Tell now. What is the conversion ratio, dear? 10,000 into 3 is equal to 30,000, guys. And the date is 1 July. So what is the weighted average? Basically, it's 1 4, it's 1 lakh, 12 by 12. 1 lakh is normal shares. Okay. And 1 7, it is 30,000 from today only into 9 by 12. Do it. 1 lakh. Okay. What about the numerator? What about the numerator? EBIT is 12 lakh. EBIT is 12 lakh. Yes, I will take interest. Definitely, I will take interest. Minus, what is the rate of interest? 9% convertible compulsory, 10,000 into 100. So calculate the 10,000 into 100 into 9%, 90,000. 90,000 multiply by how many months? From July into 9 by 12. That is 67,500. Now, what is the net? 12 lakh minus 67,500. It's 1132,500. What is the tax rate? There is no tax rate. This is 180 tax expense directly. So 952,500. 952,500. $952,500. Yes, tell me. Now 952,500 divided by 122,500. What is the EPS? 7 point 7 8. Understood, guys? What? What tax saving? It is final. 180 is after all effects. 180 is after all effects. Okay, come to the right issue wala point. Come to the right issue wala point. Right issue of shares. Right issue of shares. Alright. Right issue of shares. So right issue of shares is only for basic EPS. Under right issue, basically what is the formula denominator? How you calculate the denominator, that is weighted average outstanding. How you calculate the denominator? It's basically number of shares multiply by time weight multiply by right factor plus number of shares after right issue multiply by time weight. That's it. This is the formula basically. Time weight to be done on cumulative basis. Remember, time weight on cumulative basis. Time weight on the basis of cumulative weight. Cumulative the second alternative here. This second alternate we did now. Cumulatively. Yes. From previous date to next date. Understood? Okay, great. One more thing. What is right factor? Calculate. Sorry. See. Right factor. Right factor is come right price divide by X right price. Come right price divide by X right price. Come right price divided by X right price. How to calculate the X right price? How to calculate the X right price? Hmm. Okay. Shares before right multiply by come right price plus right issue proceeds whole divided by total shares after right. All right. Let's do one question. On right issue. Okay, come to this question 404. Come to this question 404. Calculate basic earning per share for the period ending X0, X1, X2. 3 years they are giving. When the profit attributable to the ordinary equity shareholders of the parent entity 1100, 1500, 1800. Shares outstanding before right issue 500. The right issue numbers 1 new share for every 5 outstanding. That means 100. It should be 100. 1 for each 5. So it becomes 100. Exercise price is 5 rupees. Exercise price is 5 rupees. Date of right issue 1st January X1. X1 means the second year beginning. Date of right issue. Last date to exercise the right, that is 1st March. Means they are giving us the period to think. So 1st March is the last day to exercise the right. Market price of the one ordinary share immediately before exercise is 11. This is beta come right. This is come right price. Whenever they say immediately before exercise, that means it's a come right price. Now what is the date? Last date is reporting date is 31st of December. 31st of December. Okay. So now see what are the points we have. What are the points we have? Look into the screen, please. Tell me, there are 3 years now. In which year we are doing right issue? The second year. Huh? Okay. Now tell me, what is the number 1 point? What is the right issue proceeds? Is 100 numbers at 5 rupees. 500. Done? What is come right price? 11 rupees. How to calculate X right price? 11, na? It's 11, no? Ah. It's 11. Now tell me. Tell me. X right price, how to calculate? Number of shares before right issue 500. What is the market value? 11. Plus what is the right issue proceeds? 500. Whole divided by total number of shares after right issue 600. 500 into 11 plus 500 divided by 600. It's 10 rupees. So what is the right factor? 11 divided by 10. So this is it. This is the first part of the question. This is the first part of the question. Huh? Now, how many years we have? X0, X1, X2, right? Tell me, original EPS we calculate, first of all. X0, in X0 what was the earning?
1100.
1100 divided by number of shares in the X0?
That is 500.
Only 500 was there, no right issue was there. So divide by 500. Please tell me the original EPS.
2.2.
2.2. But in the next year, you tell, in the next year, what was the earning?
1500.
1500 divided by, now very most important. Now, I told you right issue, in right issue, the denominator we calculate used to this. Number of shares prior to right issue. How many number of shares are prior to right issue? 500. Multiply by time weight on the cumulative basis. Now what was the last date to exercise the right? First. And what is the beginning of the year? January. So these are outstanding only for 2 months. Technically from beginning to the date of last exercise. Huh? January, February. multiply by right factor.
That is 1.1.
Multiply by right factor. That is 11.10. 11 upon 10. Plus. Now tell me the number of shares after right issue.
600.
Guys, I am just following the same formula. Number of shares after right issue. Tell me. 600. Multiply by the time weight. Cumulative time weight. Now it becomes 10 by 12. Are from March onwards to December. Okay, now tell.
Denominator is 591.6.
Yes.
2.54.
2.5. 2.54.
Yes, sir.
Next one, X2. What was the next? What was the earnings? 1000 divided by how many shares are there now? In the second year, in the next year, what is the number of shares? Technically, overall 600. From very beginning, all the shares are outstanding, na? In the next year, all the shares are outstanding from very beginning. So 1800 divided by 600, it's 3. So it is the original EPS. But one more thing, we need to calculate the restated EPS. We need to calculate the restated EPS of X is 0 only. X is 0 only. Whenever we calculate the right issue, na, we restate our previous year, comparative year EPS also, considering this right factor. How? The earning part was 1100. The earning part was 1100. Last year, how many number of shares were there? 500. They were outstanding for whole of the year 12 by 12, but multiply by that time right factor 11 by 12. 11 by 10, sorry. Please calculate. 2 rupees. It's 2. So this is how you used to calculate the right issue. Guys, understood or not? So that was right issue. Okay. In this way, our INDAS 33 is complete. Now 21. INDAS 21. Okay. Fine. 33 is complete. Huh? Okay, diluted remains now. I was just checking.
You asked 36 complete.
33 I said, no? Feelings. Okay, where were you guys?
So this George supposed to his friends.
My friend was completely talking with this guy. They didn't
His
care.
very close friend.
It's very
His
close.
Very close friends. Friends with benefits.
Okay, come to the next point. Diluted earnings per share. Diluted earning per share. Diluted earning per share. Guys, why we calculate diluted earning per share? Anybody? If you could explain why we calculate diluted earning per share? Because of potential equity. What is potential equity?
Convertible debentures.
Potential debentures will be converted. Very good. They have the potential to convert into equity shares in the future. So what happened then? Why it will dilute? Ultimately, the denominator will get increased without not much effect in the numerator. Very good. The simple understanding is When we have equity shares, ordinary, we calculate EPS. But we have something extra. It's not equity, we have something more. We have some other securities. And those securities have the potential that they may convert into equity in the future. If this would happen, maybe our earnings per share gets dilute because of their conversion into equity. They may not affect, the conversion may not affect the existing earning. Basically, see, there's a direct relationship between the issue of shares and the increase of earning. Whenever the company issues a share, it raises the funds. Whenever it raises the funds, it apply the funds in the business. It apply the funds. It is basically the business will earn them the profit. So technically, raising the fund from the market, issuing the shares, and raising the fund from the market, we can say that is there is a directly relationship with the increase in earning also. So there's a simple understanding that whenever we issue the shares, our earning would increase. But now the exception is whenever we convert those securities which have the potential to convert into equity. Suppose I have the debentures. Now the debentures are convertible. Suppose in the future the convertible debentures would get converted into equity share. Their conversion won't affect the earning basically. Their conversion into equity won't affect the earning. Why? Because the additional funds are not raised in the company. We have just reduced our liability and converted into equity. So what is the basic understanding? Whenever we issue the shares in the market, we raise the money, we should understand that our earning would increase. That means the denominator is getting increased because of the issue, but the numerator will also get increased. This is a general rule. But what is exceptional rule is when we convert any security into equity share. Converting any security into equity, it does not give us the additional funds now.
Yes, yes.
What would be the entry in that case? Debenture account debit to equity capital. We are not getting the bank account, basically, conversion. So in the conversion, we are not getting the additional funds. Not getting the additional funds. That means our earning will not be affected. That means the numerator is same. But the denominator is increased. Now the numerator is same or numerator is bit different, not actually changed, but the denominator is the denominator is getting increased. Definitely the earning per share gets diluted or reduced. Suppose, okay, let's take another example. Suppose I decided that this is the last class and I want to give the party to you all. Okay, I bought one cake. I bought one cake so that it can be distributed to everyone. But I doesn't counted them, those who were late. Actually, I counted everyone, but except them. Okay, I bought that much cake that can be distributed among only, not them. Okay, so now I ordered that cake. Now, as soon as we started cutting the cake, they came. No, not understood. They came and they, sir, we also want cake. Oh. Cake, sir, we need a cake. Now tell me, the same cake is now to be divided between more students. Huh? So the earning per cake, cake per student. Cake per student, the piece per student will get reduced. Simple? Understood or not? So who they are? Potential equity shares. Tell me now. Who they are? Potential equity shares. Guys, have you understood or not?
Yes.
Now don't take me seriously. I haven't ordered any cake. All right. Huh? Sorry? Time is still available. We can order, definitely. I'll order. Okay, not an issue. I'll order and we'll cut the cake. Don't worry. Not a big deal, yaar. Okay. We'll cut the cake. Okay. Whenever we take the break, na, just remind me. I'll order. Okay? Which bakery you want? I'll order. No, I will not consider you guys. Excluding potential. We'll calculate the basic earning per share. Okay? We don't know the diluted part. Okay. So, yes, tell me what we were talking about. Diluted earning per share. Guys? Diluted? So, in diluted earning per share, you guys will always available. You are, who are you? Ordinary equity share. But they will also available now. Who are they? Potential, because they are getting converted into equity. Earlier they are debentures, earlier they are preference share, earlier they are share warrant, earlier they are ESOP. Are you guys understanding or not? Share warrant, ESOP, convertible preference shares, convertible debentures, share application money pending allotment. Okay, contingently issuable shares. These all are potential equity. They have the potential to convert into equity share. They may or they may not. We don't know. But why we are calculating diluted earning per share? To let them know, ordinary people, ordinary equity shareholders, that okay, right now there is earning per share, it's a good earning per share, but in the future we may have a reduced earning per share. Take care of that. A prudence principle. Understood or not? So this is the simple concept of calculating diluted earning per share. Before going further, I'll once again repeat the examples of potential. What are the examples of potential? First, convertible debenture. Second, convertible preference. Third, ESOP, share warrants, share application money pending allotment, contingently issuable shares. These all are the potential equity shares. Have you understood or not? Except contingently equity shares and share application money pending allotment is of no use basically. I'll take one example covering all these things. What are the things? Convertible preference, debenture, ESOP, share warrant. Contingently issuable share I will consider separately basically. Okay, so I'll consider these four. Okay. Example. Number one, EAESH. What is the full form of EAESH? Earnings available to equity shareholders. You guys came, you are guys like, what do you want? Huh? You want to go? Want to meet her again? Him or her, whatever. EAESH. 22 lakh. 22 lakh. Please keep writing. Tax rate 25%. Outstanding ordinary equity 110. Outstanding ordinary equity 110. %9 convertible debentures outstanding since beginning of rupees 50 lakhs, face value 100, were converted in current year on 1st February. Converted in current year on 1st February in the ratio of 3:2. 10% convertible preference shares of 30,000 numbers issued on 1 October in current year. Convertible after 3 years. Ratio 1:2. Issued share warrants on 1st January of 15,000 numbers. ESOPs outstanding during the year are 80,000 18,000 numbers at exercise price of 30. Market price per share 50. All right, the tax rate is there, everything is there. Calculate basic earning per share and diluted earning per share. You tell me the basic.
Basic is 20.
The basic is 20. Basic is 20. All right. Solution. Basic earning per share 22 lakh divided by 110. It's 20. Now guys, look into the entire process, how to calculate diluted earning per share. It's very quite important. There are so many multiple type of securities. Let's discuss about them one by one. Potential, not. Step number 1. Identify potential equity numbers. Number 1. What is the number 1 in the example? 9% convertible debenture. Okay, let's do it. What is the conversion ratio? What are the number of debentures? Anything? Outstanding 50 lakhs. So 50 lakh divided by 100, that is 50,000. 50,000. Multiply by, what is the ratio?
3:2.
into 3 by 2. Tell me. 75? So 75 are the potential equity. What is the heading? Identify potential equity. Now second. Anything second?
10% convertible. 10% convertible preference.
10% convertible. Preference shares. Okay, what is the numbers right now? Right now, 30,000. We issued it today. We issued in the current year only, right? Okay. Yes, we issued in the current year today. What is the conversion? One for every two. One for every two, na? Into 1 by 2. That is 15,000 number. No. Wait. As far as these convertible debentures are concerned, look into the year. My year starts from 1st April. My year ends on 31st March. Can you please let me know about the convertible debentures when it was out? Since when it was outstanding? In the beginning. Since the beginning. Here. Are they converted in the current year? First Feb they converted. You know what? Are they potential in the April? Yes. May potential, June potential, July, August, September, October, November, December, January, February, not February, till January they were potential. They have the potential of conversion. But after 1st February, they don't have potential. They converted. So tell me, are they potential? Yes. For how many months? For 10 months they are potential. For 10 months potential. Understood or not? Tell na dear.
Yes.
Now next one you tell. Again do it the same thing. They were issued on 1st of October. All right. On 1st of October they issued. So were they potential before that? No, they were not outstanding at all. They were not ordinary equity. They were not potential also because they newly issued in the 1st October. Na? Okay, now they are potential from 1st October onwards. Yes, potential. October, November, December, January, February, March. They are potential for the next 6 months because they are getting converted after 3 years. So they are potential only for 6 months in the current year. Potential for 6 months. Understood? Not understood. Next. Share warrant, is it?
Yes, sir. 50,000.
Yes, tell me. When you have issued?
First Jan.
On 1st Jan. On 1st Jan. So they are potential for January, February, March. 3 months. Because before Jan they were not outstanding. Before Jan there was no concept of share warrant basically. So they were not potentially convertible. Na? Potentially convertible becomes done only when they were issued. Okay, last. ESOPs. Now tell me how many ESOPs are outstanding during the year?
18,000. 18,000.
18,000. At what exercise price they can be issued? Huh?
30.
Multiply by 30. How much funds we get? 5 lakh? 5 lakh? If the same funds could have been issued in the market, at what value would it be? 50. So tell me the numbers. 10,000. So 10,800. Now tell me the potential number. Potential equity are 18,000 minus 10,800 only. 18 minus 10,800 only. 7,200. Potential are 7,200. These are potential for 12 months because I haven't given the date. In ESOP you used to make calculation like this. Do you want me to explain? Okay. 10 minutes back I discussed one thing. Whenever the company issues funds in the market, we always assume that when we are getting the funds, our earning would be increased. But when the company converts the existing security into equity, we are not actually getting any funds. And since we are not getting any funds, our earning will not increase. So these equity which were converted are actually the potential because they are diluting our earning. Suppose the company is planning public issue, pure normal public issue after 2 months. Is this a potential? Is this a potential equity share? Will you consider them in the diluted earning per share? No. Why no? Planning an ordinary issue in the future cannot dilute your share, dilute your earning. Why? You get funds. You apply the funds. You get the earning. Earning will be increased. In the same way, ESOP are this. See, while ESOP, you are not issuing the ESOP into free of cost. You are issuing the ESOP at 30 rupees. So you got the fund, na dear. You are getting the funds now. So I cannot say that all the 18,000 shares are potential. They will dilute my earning. No. Only 7,200 will dilute my earning because by issuing 18,000 shares at 30 rupees, I got how many funds? If I get the funds, my earning will increase definitely. But if the same funds would have been issued from the general public at 50 rupees, only how much shares I would have issued? That means 7,200 shares I am issuing free of cost. 7,200 shares I am issuing free of cost. So tell me, 7,000 shares I am issuing free of cost, they will not increase my earning. They will dilute my earning. They will dilute my earning in any way. Today is the last day of the class. Now someone new student came here. And we already bought a cake. These are potential. Okay, now I understood they are there from the very first day, but they are potential. Suppose one new student came today only in the last topic, INDAS 21. He said, sir, I also taken the admission. I don't know he took the admission or not, but I already bought the cake. Now tell me, I have to give the cake to him also. As a courtesy, I have to give the cake to him also. The earning gets diluted or not? But he came free of cost. He came free of cost. He has no connection with our class. So technically, like this ESOP only, we are issuing 18,000 shares in ESOP. We are getting some funds. So we need to convert total 18,000. We need to convert into two parts. For how many shares we are getting the funds? For how many shares? These are bonus. The free part will reduce our earning. The main part, 10,800, will not reduce our earning because you are getting the funds against it. Are you guys understanding or not? Yes. So they are potential for 12 months. Survive 12 months. I haven't given any date actually. I had just told during the year. So I'm assuming that it is outstanding since beginning. Throughout the year. Guys, understood or not? So you got the potential. Have you got the first step now? No. Yes. Have you got the first step now? Yes. Okay, this is the potential. Next, what to do now? Now what to do? calculate incremental EPS for each potential equity. Calculate incremental EPS for each potential equity. Who was the number one? 9% convertible debenture. Tell me, when it gets converted, or what was the date of conversion basically? Huh? First Feb now? So how many months interest you gave them? Huh? 10 months. Hey yaar, see this. They are 10 months potential now. So calculate the 10 months interest. Suppose if they could have converted in the beginning only, how much interest saving would be there? Interest saving, numerator, interest saving. Interest saving. As per the example, the convertible debentures outstanding are 50 lakhs. 50 lakhs, 9%. 50 lakh, 9% into 10 by 12. 3 lakh, 75,000. This is the numerator. Divided by how many potential are there? 75 now. Divide by 75,000, multiply by 10 by 12. Calculate the incremental earning per share.
It's 3,75,000.
Sorry, it's a 375 now. Huh? Achha, is there any tax rate? Is there any tax rate? So deduct that, multiply by 75% only after tax effect. After tax effect. See, this logic is simple. If they would have converted into equity, the interest would be saved. If the interest would be saved, the earning would be increased. The earning would be increased. The tax will be deducted. The tax will be paid. So technically, my net earning would be after tax only. So if they would have converted into equity, this much interest of 10 months would have been saved. This much interest of 10 months would have been saved, but when the interest will be saved, the tax will be levied on the earning. So only the 75% after tax effect will be saved. Divide by numbers. Now calculate the incremental earning per share. Tell me. Huh? 4.5. Okay. The next one. The next one. 10% convertible preference. When they were issued? Or tell me the potential period. Huh? So calculate the 6-month dividend. Potential period 6 months. Calculate 6-month period, 6-month dividend. Calculate 6-month dividend. Any face value they have? 100 rupees. Yes. 30,000, 100 rupees. That 30 lakh into 10%. 1 by into 6 by 12. 150. So we issued them on 1st October. From 1st October, they are eligible for the dividend. From 1st October to 31st March, they are eligible for the dividend. Suppose they are equity from very beginning. So our dividend would be saved. So dividend would be saved. So it will increase the earning of the equity. 150. And how many potential shares are there? 15,000 into 6 by 12 potential month. Tell me. 20. All right. The next one. Guys, share warrant are not have any dividend. Share warrants are don't have any interest, don't have any dividend. So numerator is 0. Divide by number of months, number of shares. 15,000 potential month. 3 by 12. It's 0. Guys, last.
Yes, ESOP also the same.
ESOP also same as share warrant. They don't have any dividend policy. They don't have any interest policy till the time they are ESOP only. So 0 upon
That is
7,200 into 12 by 12. Why 12 by 12? Potential for the whole of the year na 0. Done, beta. Now go with the increasing order. Go with the increasing order. What is the first place? Increasing order. Increasing order. From low to high. From low to high. 0. I will treat it first rank. 0. I will treat it first rank. 4.5. I will treat it second rank. 20. I will treat it third rank. Just write it first. I'll tell you how to work on. Now finally we calculate diluted earning per share. Finally we calculate diluted earning per share. Particulars. Numerator. Denominator. Earning per share. What was basic? What was basic numerator? Basic denominator? Basic numerator was? Basic denominator was? 110. EPS was? Plus. Take the first rank. Take the first rank. Which one is the first rank? Share warrant and? Share warrant ESOP. What is the numerator? 0, 0. What is the denominator? 3750. Next one. 7,200. Make a total. One two zero nine five zero. Yes, make a total. Hmm?
18.19.
Is it diluted?
Yes.
Is it diluted? Yes. But there are more chances to do its dilution again. Well, it has so much potential to be diluted once again. Now second rank. Second rank. Convertible debentures. Tell me. Numerator. Uh-huh. 281, 250. 62. Okay, do it now again. Do it. Hmm?
13.53.
Oh wow. It gets diluted once again. Last. Okay. What was the total here? 24, 81, 250. And that was? Now last one. 150. 7,000. Do it. 26, 31, 250. 190, 950. The answer is 13 point.
7, 8.
Compare it with the previous one. This is called anti-diluted. That means this potential equity is not diluting actually, is not diluting my earnings actually. Preferential is not diluting my earnings actually. So what is my final answer? What is my DEPS? It's 13.53. You can consider this as a master question. We forget actually that one. You are right actually. Our basic EPS actually not this. Why? Because these are already gets converted in the February month. Tell me now how many numbers were there after conversion? I think 75 now. So technically our BEPS would be 110 plus 75 into 2 by 12. It's 122 500. So it's not 20. It's actually 17.96. Done? So if it is 17.96, first of all make a correction here. You understood now? Actually we forget to consider that conversion for 2 months. Now our entire working will be revised. Okay, here what to do? $22. It's 122 500. 17.96. Can you please further make changes here? Can you please tell me the figures? The denominator. 133. 33, huh? 33. Tell me how much? 16.49. Next.
12.66.
What's the denominator value? Denominator.
195, 950. 12.66.
66. Okay.
2,03,450. 12.91.
12.91. Anti-diluted. So our final answer is
1.66.
One more point, call option issued and written by the entity. Call options. It is just same like ESOP, call options. If the company gives the call options, they are also the potential equity. If the company issues call options, they are also the potential equity. But there are two things. One is in the money option, one is out of the money option. Have you heard this term? In the money, out of the money, futures and all. So in the money options, out of the money options. How it works? Company issues call options. Company issues call options. 10,000 numbers at exercise price 30. Case 1, market price on balance sheet date. Market price on balance sheet date 25. Market price as on balance sheet date 40. Tell me, in which case you will avail the option? Company gives you the call option. In which case you will avail the option? Case 2. Why case not? Why not case 1? Huh? Call option means you have the right to buy the share. So you have the right to buy the share at when it already available in the market at 25. Will you buy? Will you buy from me? No, it is out of the money. So there is zero potential equity share. Zero potential equity share. Because I know, company know, he is not going to come to me to buy. Understand or not? So zero potential. Tell me in the case 2. Will you come to me to buy the share? Will you come to me to buy the share? Yes. When? Why? It is available in the market at 40. I have given you the right to purchase at 30. Will you come to me? Yes, there's a potential. And if it's so, what funds I would have raised? As per the 30 I will give you, na? So tell me the value. 3 lakhs. The same could have been issued in the market at 40. $7,000. So technically I am giving you 2,500 shares at free of cost. These are potential equity. Just like ESOP. Just like ESOP. Have you understood the things? So call options, out of the money, in the money. Out of the money, zero potential. In the money, just like ESOP. In the money, just like ESOP. These are the call options. Okay, whatever we discussed in the last question, everything step by step is written here. Step by step, everything is written here. The page number is 21.14. Everything is written here. All the steps, okay? Now the next part is contingently issuable shares. The next part is contingently issuable shares. Guys, contingently issuable shares are means, you remember our first day discussion? You won't remember, right? Let's Contingent consideration. Purchase consideration includes contingent consideration. What do you remember? Wow. Okay. Contingent consideration is based on the future conditions. If the condition will be fulfilled, then only I will give you the extra shares. This is contingent consideration. One more point was there. Contingent consideration is based on the employee services. They are not the part of PC. These are contingently issuable shares basically. Contingently issuable shares are based on the future fulfillment of future condition. If the fulfillment of future condition will be done, if we expect that the condition will be fulfilled, or if the condition is actually fulfilled, then only we take the shares into consideration for the calculation of EPS. Now the question is, when we should take them in the basic EPS, when we should take them in the diluted EPS. If you read these points, read this point in decode. If the condition is satisfied but the shares are still not issued, actually to be considered in the basic as well as condition is satisfied, shares are, so they have the full potential to be issued. Understood or not? But condition is already satisfied. It is already sure that they will be issued. Understood or not? Second, if the condition is satisfied at the balance sheet date, but the final compliance date of condition is in future, treat potential equity included in DEPS. I will tell you the example. I told you that if you are my employee and I will issue you the shares in the future subject to the condition that next year in the same month July my share price should be 600 or more. Right now the share price is 400. If it's so, I will give you the shares. First of all, is it a contingently issuable share? Huh? What is the contingency? Market price. What is the condition basically? What is the condition? Market price should be 600 or more in the next 12 months. Then I will give you shares. Next year, in the month of March, balance sheet date, market price already crossed 600. Market price already crossed 600. So it becomes highly chances. Now there are high chances that this market price will retain at 600 or more only. So in the balance sheet date, already the share price get increased beyond 600. But what was my condition? What was my condition? By July end, it should be at least 600. But it is already 600 by the March ending. So now read the point. Now read the point. Condition are satisfied at balance sheet date, but final compliance date of condition is in future, July. You understood or not? Then treat potential equity and include in DPS. On balance sheet date, you will not treat them in the basic EPS. You will treat them in diluted earning per share only. So what is the rule, guys? The rule is very simple. Is the condition satisfied or not? Point number one. Is the condition satisfied? Once it is satisfied, take them in the basic EPS. Yes. Second, condition is going to be satisfied in the future, but as on balance sheet, it is almost satisfied. Only DPS. Guys, are you understood now? Okay. Condition is satisfied. Shares are also issued. Basic EPS. Part of basic EPS. Understood or not? Simple. The last one. What is the last one? Entity with discontinued operation. I really don't know this topic. Okay, let me give you the example. Let me give you the example. Tell me, you know the continuing operation, discontinued operation, you know? Huh? Okay. continued operation, discontinued operation. Continued operation, discontinued operation. Uh, 50 lakhs. 20 lakhs. Ordinary equity 1 lakh. Potential equity numbers 50. Calculate basic and diluted. It's quite simple, just calculate it. Can we shoot after 5 to 7 minutes? It is about to end after 10 minutes. Yes, tell me the answer. Okay, I am asking basic EPS for continuing. It's 50 lakhs divided by 1 lakh. How much? 50. Tell me diluted EPS for continuing. 50 lakhs divided by 150. All right. 33 point. Very good. It gets diluted. Is it diluting? Yes. Very good. Tell me basic EPS for discontinued. Sorry. It was negative 20. It was negative 20. Yes, tell me negative 20 divided by 1 lakh. It's minus 20 EPS. D EPS for discontinuing operation. Tell me. Negative 20. Negative 20 divided by 150. Huh? 13.33. Negative. Is it diluting? Is it diluting? It is not diluting. But it doesn't matter because it is a discontinuing operation. INDAS allows. Okay, fine, not an issue. Just wait and watch. It's a discontinued operation now. INDAS doesn't have mind and INDAS don't mind in this. Okay, leave it. Continue. Are you guys understanding or not? But the situation will be different. The situation will be different when the continuing operation is in loss. Now the continuing operation is in loss. Now the situation will be different. Okay, tell me what is the basic EPS? Let's calculate continuing operation first. What is the basic earning per share? 50 divided by 1 lakh. How much? Second, DEPS. Minus 50 lakhs.
Divided by 1 lakh.
150. Just use 150 first. DEPS, no? It is written, but I'm making some mistakes intentionally. Do it. 33 point. What can you see? Anti-dilution. Now read this. If there's a loss from continuing operation, EPS from continuing operation will get anti-diluted. Is it so? Say na yaar. This is possible because of the potential shares in denominator. Of course, when you increase the denominator in the negative side, in the negative earning, it gets anti-diluted. So what is the conclusion? DEPS will be calculated without considering. So now correction. Correction is take 1 lakh only. Means 50. Understood, guys? Tell na, understood, guys? Yes. So you cannot take potential equity in the new denominator in case of loss from continuing operation. What is the conclusion? If you can write in your words, we should not take potential equity shares in case of loss from continuing operation. Sir, if there's a loss in discontinued operation, doesn't matter. It doesn't matter. Okay. Hooray! Topic is done. INDAS 33 is fine. Over. Okay. I'm giving you some most important questions on INDAS 33. Just tick those questions. Question number 201. 201. Question number 203. 203. Right issue we already did. 404. We already discussed. Question number 505. Question number 505. 505. Six one zero. 610. 611. They have QR codes too, don't worry, Hana. So it will work definitely. Six one four. 703. 703. And 806, guys, 806 is highest important. 806 is most important. Refer the QR code especially. Refer the QR code especially. 806 is too much important, too much. That's it. So, India's 33 is over.